Okay, cool, perfect. Let's go. So, guys, welcome to the call. For those of you who don't know me, my name is Gaurav Season, and I'm actually, excited for this call. But before we get into it, I just want to obviously welcome you guys. You guys are spending your evening here. There's an opportunity cost to being plugged in today. You guys could be doing so many things. You guys could be watching your favorite TV shows, sleeping early, Netflix, whatever the case, but you guys are here plugged in, and you're looking to better yourself. So thank you for that. And because you guys are already here, there is just one or two things that I ask from you, which is, number one, give us your attention. Don't be here and then you're on Instagram half of the time. You're watching some cat videos or something. So be here and then really focus, and I promise you it's going to be worth your while. Um, Other thing, as I said, is the house rules, which is just number one: respect the speaker, respect the community, respect the space. Don't kind of spam the comments section, just in case this can just take off from our train of thought. So respect that, and make sure. Cool, there you go. Okay, yeah. So respect that, and I think this will be it. So we're gonna be here for about an hour or so, not too long, and yeah, let's get into it. So today, I just wanna introduce someone. I don't want to be rude to my other guests. I believe this is my 15th episode now, so we've had some pretty special guests, but today this one is really personal. This one is really close to my heart. I first met Nick, I believe it was back in 2016. And I just want to start off with one quote. One man can change the world, right? And I believe this is what this person has done for me, because 2016 I was 18, just finished my A levels, just exploring my options. Okay, I didn't want to go the traditional route of just going straight into uni. I wanted to kind of explore the world a little bit, simply because for me, I've done like a quick maths. The maths that I've done was, there was a lot of students in my A level studying economics. And then, when I was going out for like open days, I could see the subject economics was a hot subject, right? A lot of people wanted to do that, wanted to do finance and business. So, I just thought, okay, cool. In UK, there's a lot of universities, probably about, over 100. And then this is like a minimum 3-year course. So think about all of the students that were studying a very common subject, and the job that was going to be at the end of the course was very limited. We definitely had way too many students for the available job. So I wanted to have something underneath my belt that could stand me out from the crowd. It wasn't just my qualification. So this is where I was doing a lot of like volunteering, a lot of placements, including Artemis, Investec. I've done some time at Coots. So again, during that time, I came across Nick, but I started working closely with Nick when he partnered up with another wealth management company called Investec, where he delivered an investing program for young people like myself, mostly graduates. And this kind of, as I said, this for me gave me that first introduction into investment, and that gave me that first introduction into like the finance world. As I said, I had the only thing come closer to it was my economics studying, but this was like the hands-on experiment that I got. So having said that, as I said, this gave me that first introduction, and ever since, this, as I said, changed everything for me. It really gave me that taste, and I liked the taste, and I wanted more of it. So this is where put my head down, really looked at what it is that I liked, and then just kind of followed that path. So without further ado, I'm going to see if I can just unmute him, add spotlight firstly.
Hey Gaurav, I'm on.
There you go. So Nick, how you doing, man?
Yeah, good. It's great to see you, buddy.
Good to see you too. As I said, I know it's been such a long time. I believe over 5 years plus. So great to see you too. How's everything going?
Yeah, good. It's been an interesting couple of years in the markets, and then that's from just the volatility of the past year has been pretty crazy. I became a professional money manager in 2007, so I've been an assistant fund manager before, but joined a hedge fund, became a fund manager in 2007. So I've done the great financial crisis, the Eurozone crisis, Brexit, and now COVID. So still learning, that's the thing about the job, but I really thought once I got the first 3 done, I think how much worse can it get? And then 2020 hits you. But personally, it's been all good. Emma and I are in a lovely family home that we moved into a year ago. We've got a little girl, Isla, who's 4 months old. And I've got my 2 screens here. I've got Zoom, I've got my work, and I've got another little one, which is Isla, and I'm watching her on the monitor. Emma is busy at the moment, but so if I run out of the room, it's because Ida's crying. They just need to settle her, but I think it should be okay.
Yeah. Again, we appreciate you for being here, man.
It's great to be here. Thanks for the opportunity.
No worries at all.
It's really interesting for me. It's nice to meet people who are enthusiastic about markets as well, and just have a chat with people who sort of share a passion for self-improvement and learning and progression and being ambitious in life.
100%, yeah, for sure. Cool. So let's get started with the introduction. So how did you end up in the finance world? What made you choose economics and what made you carry on with it? Because a lot of people, again, I kind of experienced that a little bit. A lot of people, they start off uni thinking they would like the subject. At the end of the course, they choose completely something different, or they end up graduating, but then they do a 9 to 5 that's got nothing to do with the degree. So for you, you've graduated, not only that, but you've been in the industry for 10 years plus. So you must really love what you do. So talk to us about how you got into it and then, what made you carry on?
Yeah, I think there's a few really good lessons, which is the first one being no one really knows what they want to do. Anyone who says that they do from a young age, maybe they're being too narrow in their thinking. Life is a journey. You've just got to engage with it and see, have an idea of where it sets you, but you've got to have pretty broad tram lines, I think, to get the most out of it. And I ended up doing what I'm doing kind of by accident. What I really wanted to do was be a rugby player. And I played rugby at quite a good level. I played for England students, and I played for a year in France. I did economics and French as my course. I spent a year living in France playing rugby. But I realised it wasn't going to happen for me. I wasn't quite good enough to make it the top level. And I thought, well, I need a sensible job. Well, a proper job. And I think what I figured out was something similar to you, Gareth, that when you do a job for your career, you've got to find something that you enjoy, because you spend so much time there, and actually also you're going to be better at it. If you're doing a job that you're not passionate about, you won't do it to the best of your abilities. So somebody has said to me, look, have a look at finance in the city, because people there seem to enjoy what they do. They work hard, but they get paid well. I thought, well, it's a good place to start. And I applied for various internships. I'd always been quite interested by the stock market as an idea, but I didn't really know what it was. And I got an internship over the summer between my 3rd and 4th year at university. I did 2 years in Nottingham, a year in France, and a year back in Nottingham. And I got an internship with an asset management company that was investing in the UK stock market. And I did it for about 2 months. And I thought, wow, this is actually really interesting. I've got a bit bored of studying. I didn't really see the point of it. But what I realized was, when you're studying, you're just trying to get good grades from your teacher so that you come out of your course with a good grade, which means doors are open for you. So I'd kept my options open by doing economics and French, 2 quite different subjects. And I just fell into this, ended up with an internship and thought, wow, the stock market is really interesting. And everyone I knew was struggling to think what they wanted to do for a job. And I thought, if everyone's not sure, everyone knows they're going to have to work hard, you may as well do something you find interesting that could pay you well if you're good at it. So that's kind of how I fell into it, and then decided that I'd try and get into investing shares professionally.
Awesome, great. And I'm gonna touch on that a bit later, but I do believe some of your family members are also in the game as well, right? I believe your mom's got a portfolio.
No, not quite. So I grew up in a place called Harrogate, which is in Yorkshire, so near Leeds. And my mum and dad ran a small family business, and they, as entrepreneurs, they had money that they needed to invest, so they ran their own pension fund. I'm sure a lot of people on this call know, if you're in the corporate world, there's a lot that's not great about it, but you do get healthcare and you get help with pensions. Whereas if you're an entrepreneur, you have to do it all yourself. So my parents were a bit interested in the stock market, but they didn't really know anyone who was in it, and they didn't really know how it worked. So they did a bit of investing. But one of the key lessons I took on board, which I think you've all taken on board, is you don't make money keeping cash in the bank. You've got to invest to grow your wealth. And generally, the hardest part is getting started, getting some wealth to begin with. So yeah, I think my mum pointed me in the direction. I think she was the one who had a friend who works in the City of London. I didn't know anything about it. I didn't know anyone who worked there. And she said, just have a look at it. You might find it interesting. If rugby's not worked out, give it a go and see how you get on.
Okay, that's interesting. Cool. So I'm gonna start with the biggie, right? So anytime I have someone, someone professional, someone who's been in the game 10 years plus, one of the key questions I ask them is about risk, because no matter what game you're playing, whether it's the forex market, the stock market, options market, whatever, risk is always going to be there. Okay, number one. Number two, when we look at it, like for us, I would say we are like, the retail traders, we are like the small fish in the big ocean. Okay, so you guys manage risk on a daily basis, but to an excessive amount as well. Okay, and you're doing this so well, obviously, because you're getting your return. So what, let's talk about risk a little bit, and what could some of us, some of the retail traders, some of the entrepreneurs, maybe tweak our mindset a little bit, maybe tweak our position sizing a little bit to kind of really tackle that main problem of risk?
It's a great question. And I really like the way you've approached it, because most people look at investing and say, right, how much money can I make? And I think in the US, there's a really strong culture of, which I personally love, which is energized, right? So people just want to get on in life. And if your neighbor succeeds, you're pleased for them, and it makes you work harder. In the UK, we can sometimes be a bit jealous or look down on people who are trying to get ahead. So I love that. So in the US, they really understand investing and how you have to invest to make money over the long term. In the UK, I find we have a bit of a strange mindset that people think if you invest in shares, they expect to make 50%. They go, oh yeah, I should probably get about 40, 50%. No idea of the time frame. And then when you talk about what they could lose, they say, well, in shares, you could lose everything you own, which is really interesting to me on their risk reward. That's a bad risk reward. If you think you could lose everything you own, you shouldn't invest in shares unless there's more than 3 times the upside. So investing is all about risk and reward. And it's about understanding the upside relative to the downside. And you do that on a probabilistic basis. So life is not binary, it's not ones and zeros. Life is perceptions of reality, and that's how assets are priced as well. Well, a simple way of looking at it is, as they say, when people are greedy, maybe you should be fearful, and vice versa. And I would also explain the context of how I invest, just so that I understand there may be some things which are applicable that you guys might take on board. But I have quite a specific role, which might be different from the kind of trading that you want to do. So let me just explain what it is I do, and then we can talk about risk reward a bit more if there's any questions. Right? So my job title is I'm a fund manager at a place called Artemis, which is it's a partnership. So it's a boutique investment house. We own the business. There's about 40 to 43 of us. We own the business and we invest in our funds. We eat our own cooking, we call it. We run about £25 billion across maybe 30, 35 fund managers. I work with 2 other people on a team of 3, and we're about a third of the assets, so about £8 billion or so. So we're moving quite big sums of money, and it's pretty long term in terms of what we're looking for. So we can't get in and out of shares. So I look at risk maybe a bit differently. But what I'd like to do is share a couple of lessons that I think I've learned, and to give you the full background. As I say, I was a hedge fund manager from 2007 to 2012, and then moved to a long only product. So hedge fund managers, I'm sure you know, you can short shares as well as be long. And then what I do now is long only. So we only buy and hold shares. Doing the hedge fund first made me much better at what I do now. The way, so that's a long story to just explain the context of where I'm coming from and how I think about investments and the risk reward. Then some of the lessons I've learned about understanding your risk. I'm what you call a fundamental investor. So I like to, it fits my mindset. So I was always the kid at school that said why, and I was just always interested about why the world was the way it was. I've never been afraid of speaking my mind. And the thing I love about investing is you have numbers. So there's no BS with it. You can't talk your way into people thinking you're good at investing. It's there for everybody to see. And so I really like that. When you think about some of the key lessons I learned from 2007 to 2012 from being in a hedge fund, I think it's really understanding my mentality. And I made better decisions when I took some of the pressure off myself. When I was trying to make money, then I didn't make good decisions and I was too short term. And one of the lenses I like to apply is, how would I feel about this decision in 10 minutes, 10 hours, 10 months, and 10 years? And that's a really good way of making you decide whether you're thinking in the right framework. Because generally, if you feel better 10 minutes later, it's probably the wrong thing to have done. So if the stock is really hurting you and you think, I'll sell it, I'll feel better, sometimes that can be the point of maximum pain. But as I say, this is longer term. This is not on a daily basis for trading. I think, as I say, really understand your psychology. Sometimes you can be better working in a team. I find it's really helpful to discuss ideas with people, and then you can gauge your conviction behind it. I find it's really useful to have some banker positions. So what I like to do is run with a core that's relatively low risk, but I'm pretty confident the shares will appreciate in value over time, and I take risk around the fringes. Again, in the financial crisis, I learned if you're taking too much risk across the whole of your portfolio, it can lead you to make bad decisions. Whereas if you can breathe easy on 50, 60%, where you think it's a banker, really defensive, good quality company, you can feel more confident about taking risk. And then a couple of others on the risk management. As I say, I do everything on a bottom-up basis, so I really try to understand the company, and that makes me feel comfortable. I like to write down my reasons for an investment, and I find that keeps you really honest. It stops you drifting on your hypothesis, because going back to the probabilistic stuff, it's all about having a hypothesis and testing it. And sometimes you just got to respect the market when it disagrees with you. So I think sort of holding yourself to account is really helpful as well on a way to manage your risk and understand where you're taking it. So that's quite a lot to throw at you. I'll hand back to you, Gareth, if you want to ask any questions on that, or if you want me to elaborate on any of it.
Sure. Yeah. So just I picked up on two things. So you talked about, you working with a team. It was, relatable small team, just three of you guys. But the question I wanted to ask you was, so, let's just say you've done some of your work, right? You got an idea, but I'm not sure. Are you still working with Andy, by the way?
Andy? Yeah.
Yeah, okay, cool, perfect, right? So let's just say, you've got an idea, and then Andy's got another idea, but you guys clash. Okay, he's got his ideas, and then you've got your idea. How do you approach that? And the reason why I'm asking that is because some of us as entrepreneurs, we are in so many different groups. And again, although we're tackling the same problem, but we might be looking at something as a buy, but then someone else might be looking at a sell. But you as a trader, I believe everyone should follow their own ideas, because this is you. And so how do you approach that kind of situation?
Well, I find it really helpful, because I'll give you a good example. Okay, not necessarily Andy, but in 2008, I had a good year on the hedge fund. So it might not seem like a huge amount, but our fund was up 8% and the market was down 35%. So we made good return for our investors. And as we came into 2009, the market started to rally quite hard. So 2008 was horrible. It was much worse than last year was. Market started to rally, and we made good money. I think we were up 5% in the first 2 months. And our risk committee said, look, guys, you've had a great 2008, very marketable. You're going to bring in more assets. 2009, you started pretty well. Why don't you bank some of the profits? Because in the professional market, people are looking for 10% a year that they can trust broadly. It's not like what you'd expect for yourself in trading. You might have higher aspirations for the returns you can make. That was a good start. And they said, this is why you should take the risk down. And I just listened to them. I thought, you're not doing that for a good reason. You're just doing it because we're up. You're just saying take a profit for the sake of it. I think you're wrong. I'm right. I'm going to go for more risk. I should have taken on even more, is the lesson. So it was a good year in 2009. It could have been a lot better. So what you have to do is have like an internal dialogue as well as external. You have to put your ego to one side, I think, because you have to be pretty humble in the market. But so much of it is a balance, because you've also got to back yourself when you think you're right. And I think sometimes when you have a conversation with someone, if you listen to it, it can be really helpful to engage with that, and in terms of getting to the objective truth of the answer. And if you speak to someone and they're disagreeing with you, but you think their arguments are flimsy, and when you give the response, you think, do you know what, I think logic is on my side, I generally find that is a sign to increase your position. And so I find those discussions helpful. The key thing is just covering your blind spots, and that's what teammates can do, where they say, you've not thought about it from this perspective. But if you have that internal dialogue, you should have covered all the risks and rewards.
Okay, awesome. The other question I've had was, you mentioned a little bit about how when you've realized that you work without the pressure, your performance tends to be, tends to do so well. You work in an industry where obviously you got to give income. I believe it's monthly income to your clients as well, right? So we kind of have the same pressure as well. So it could be, we've got bills to pay. It could be we've got some sort of debt to pay off. So how do you get that pressure off you? That thought of, number one, I'm managing someone else's money. Number two, I need to yield someone's monthly income. So maybe we can start implementing the same thing when it comes to paying our bills, paying the debts, and so forth.
Yeah, look, that's a really good question. I think the starting point is to say, what are you trying to achieve? And think about putting pressure on yourself and easing pressure on yourself to make better decisions. Because when you're under pressure, I find that your logical side of the brain can push to one side, and the irrational side of the brain can take over. And that's because you're under pressure and you think, this hurts, it's painful, I just want it to stop. And as I say, that can be the cause of you buying high and selling low. And that's just a recipe to going bankrupt. So I think that, that internal dialogue is really important. But also, I think in life sometimes it's like surfing, that when it's going well, it's like you're up on the board and you're on the wave and you can see the whole shoreline and see it quite big. Or like a tennis player or cricketer would say, they see the ball big, right? But there are times when you just can't see it, or when you're getting smashed by the waves. And sometimes the best thing to do is just take a breather and come back to it. So I'm not giving you advice, but I would say think about how you get the best out of yourself, and sometimes putting yourself under pressure to deliver a certain return over a certain time frame can be counterproductive. And I'd also say, as I've gone through different chapters of my investing career, from having been young, scrappy, having a point to prove, to taking over a hedge fund where I didn't really know what I was doing, to then having that hedge fund shut down, to we lost our main investor, having to start up again at Artemis. It's different stages. Another example would be when I first joined Adrian on this franchise at Artemis. I started off, I didn't put pressure on myself. I just said, look, I've got a couple of ideas. Let's just put them in, not big positions. Let's see how they go. I built up trust with Adrian, and then they worked, and I started to get more capital. So, and those stocks perform well. With hindsight, I wish I bought more. But I'd say the lesson is figure out your own mentality and what helps you to get the best performance from yourself, and then create those conditions as much as you can. And if you feel under pressure of paying bills and things, maybe it's useful to just say, do you know what, I'm not going to put myself under pressure to turn this money into more. I'm just going to use what I have to pay the bills, take a breather, and then come back to it.
100%.
So I'm sorry, just to finish that off, I could talk all day about this because I firmly believe in the concept of Kaizen. Do you know Kaizen?
No.
It's a Japanese concept. I've been to Japan a couple of times, and again, I love the fact that they dedicate themselves to their craft, and also they're highly respectful of one another. But you could be a street cleaner, and there's nothing wrong with that. In Japan, if you're a street cleaner, you'll be the best street cleaner you can be, and people will respect you for that. And that's what I brought to my craft, as it were, for the 17 years of full-time fund management. Is just learning the whole time. And I think this is, so I could talk all day about this because I'm passionate about it and I've been on that journey. But the thing which is really, really amazing is you have to know yourself. You have to really know your psychological makeup and what, how you approach things. So
100%,
it's also good in investing in yourself to grow as a person.
For sure. I just wanna add on to that because just as you was adding that last bit, I remember a mentor of mine, Bob Proctor. So he's like a YouTube mentor of mine, right? And he talks about how the humans are the only living beings who've got the power to change. A tree can only be a tree, a dog can only be a dog, but with us, we have the ability to change from yesterday, a moment from now. And I truly think this is a powerful concept, because if you don't like something that you currently have within you, you can change that. And it's so true, it applies so well with the finance industry as well. So if something that don't work within you, if you feel like you're rushing too much into a trade, if you feel like you're taking your profit too early or whatever, guess what, you have the ability to change that, regardless of market direction, regardless of market movement and whatnot. So great topic there. But yeah, so Nick, if you would like to carry on with the story that you were saying, and if there's any questions that pick up, I'll just ask you then.
Sorry, which particular story? Because I've got a lot of stories. I could talk all day about these things.
Okay, cool.
I could give you loads of lessons that I've learned from doing things wrong.
Okay, cool. So let's go to an examples, all right? So let's start off with the classics. So one of the classics could be, let's give us an example of your best year and your worst year, and obviously the lessons that came from that.
Yeah. Gosh, this is really time for honesty, isn't it? Just so many lessons. I would say probably my worst year was 2016, where with hindsight, we had too much domestic UK exposure. And we thought the referendum result would be close, but we still thought it would probably go the way of Remain. And that was naive. And that was a bad year. So I think over the, let's say I was an assistant fund manager from 2003 to 2007 and became head fund manager. I've beaten the market pretty much every year. So I've made a lot of money for my investors and done it with pretty low volatility as well. 2016, we were down 6% against the market. And that was painful. Also, personally, I was going through a difficult time, breakup from a relationship, which has definitely turned out for the best. What are the main lessons I learned from that? I think you cannot turn your back on the markets for a moment. You must always be on top of the risks. And this might surprise you actually, but the average holding period in our portfolio, so the average amount of time we hold a stock for is 6 years. Wow. We don't turn it over very much. Last year I was active. I was buying and selling quite a bit more than usual. We hold it for a long time. So people say, what do you do all day?
Yeah, that's what I was just about to ask you. What do you do all day? Do you just look at the screen?
No, so here's nothing. I don't look at screens. I'm really respectful of technicals in the markets because they're telling me what the market is thinking. Technicals are a window into the market psychology, the collective thinking. But I make my money by thinking differently, so I try not to do that too much. But sorry, I'm rambling here because again, you can tell I'm really passionate about this. But 2016, yeah, got to be on top of your risk management the whole time, and we had too much domestic. And then one of the main failings I have as an investor is that I inherently, as a human being, I'm pretty contrarian. I always like to, say, where could people be wrong? What is conventional thinking, and where is that wrong? Generally, conventional thinking is just first layer of the onion. I like to peel the onion back to the core. And I think that is how I think. But sometimes I run losers for too long. It's really important to run your winners, but I believe in fill or kill. And if a loser stock's not working for you and your hypothesis is drifting, I think you should cut it. And in 2016, I think I was too rational. And what I should have done after Brexit is said, look, this is painful, but there's still, first of all, an opportunity. We did do some buying. Some shares opened down 50% the next day, which was crazy, like house builders. But people were still buying homes. The shares just got 50% cheaper. Should have been more aggressive buying those. And then as the year played through, I should have been more respectful of the fact that international investors would not want to invest in the UK because of the uncertainty, and that sterling would be weak. And that led to pretty profound moves in the market. Basically, overseas earners did really, really well, and domestic companies did really badly. And that went on for quite a long time. And I didn't manage the risk very well there. So that was a wake-up call. And I think as a result, actually probably handled COVID better last year. Best year could have been better. They always can be. You never get a perfect year as an investor. I think another failing of mine is that sometimes I don't paint with broad enough brush strokes. So when I've done a lot of work and I think I really understand the company and the risk reward, I think, I might go for a 2 or 3% position, and I should be thinking 4 or 5, because that makes a big difference. You make your most money not from your best ideas. You make the most money from the ideas that you put the most money behind. I'd rather have a 5% position that I think I could compound 10% in than a 2% position that could go up 20%, because over time you make a lot more money in the 5% growing at 10.
Cool. Awesome. So obviously, thank you. A lot of people just, they just want to talk about their good side and their best years. So thank you for, being humble and talking about your bad side as well.
Everything's a learning opportunity, isn't it, Gara?
Yeah,
so
that's right.
You don't learn from, sorry, can I just share another story with you?
Yeah, go on, yeah.
Relevant here. It's a great book by a poker player called Annie Duke, and she's got a degree in psychology. PhD, sorry, I don't think she completed a PhD in psychology. And she talks about financial markets from the lens of a poker player, and I love this book. It's called Thinking in Bets, and I'd highly recommend it. I think there's a tip. You can see I read a lot. You can just get such amazing insights. You can get Warren Buffett's thoughts for £10. It's amazing, and all the best traders generally. Annie Duke, Sam, is the answer. ANNIE. And then surname D-U-K, Annie Duke. She's on Twitter as well. She's really interesting. I think, so I'd definitely recommend reading these books. But one of the key points she makes in the book is it's human nature to focus on what you've done well versus what you've done badly. And poker players are completely honest with themselves. So if they get lucky and they win, they acknowledge it. You've seen some football managers, I think Marcelo Bielsa at Leeds, I'm a Leeds fan, but he'll say, right, we lost, but I think we should have won. And today we won, but we should have lost, because he looks at it objectively. And Annie's thing is called resulting. And it's basically saying, if I do well, it's skill. And if I do badly, it's luck. And that's not being honest with yourself. And poker players are honest with themselves. I think as a fund manager, as an investor, you have to be honest with yourself. Did you do well because you got lucky? Or did you do well because you did a good job?
Wow, that's a great question. That's true. That's true. So for us, we've been talking a lot about the past, your come up and stuff like that. I actually want to take it a little bit into the future now, and for that, let me see if I can share my screen because I wanted to show you something super quick. Cool. And what I want to show you guys is this. So this is on the ONS, so the government website, and it shows you everything to do with statistics and stuff like that. And I was just over the weekend, I was just having like a quick glance through, and then I saw this. It's just still loading. So it was the GDP for UK, the quarter four for 2020, right? We haven't finished the first quarter of 2020, so this is the most recent data. And this picture really surprised me simply because for the past 10 years, right? So this is a quarter on quarter data. Let me see if I can find it super quick. Where is it? Still loading, says chart. Okay, cool. Simply because for the past 10 years we've never seen anything like this. Okay, and there you go. So for those of you guys taking forever, yeah. So as I was saying, for the past 10 years we've never seen anything like this, right? And if it does, come up, well, okay, what it is. There you go. Okay, so you guys should be able to see this now, right? And then we can see for the past 10 years we've just been ranging very close to zero, minus, and we're coming up. But 2020 quarter three, after February, we've had a massive dip. Okay, minus here. Obviously, we're in a recession, and then we've had this massive recovery as well. So much so that we're now trading in this unknown territory of 16% plus, where we've never seen anything like this before. We've even gone below 2008 financial crash, minus 1.7% there. This to me, personally, I think this is not stable. But Nick, I would love to get your opinion on this, simply because, so I'm gonna come off now. Simply because with this year we've seen so many things just doing all-time highs. We've seen the indices doing all-time high. We've seen some of the stocks doing all-time highs. We've seen some major investment banks doing all-time highs, or at least they've recovered from the COVID drop, right? But on the other hand as well, right, we've got Regent Street is still not open yet, and that used to bring in billions of revenues annually in terms of retails, in terms of landlords, real estate and stuff like that. That whole street, that whole department is shut down. The British economy is not open in terms of travel, right? So again, that used to bring in billions, and yet same year 2020 going into 2021, we are seeing these all-time highs. So dare I say, is this like a bubble that we're living in, or what's your opinion?
Well, you are absolutely right to highlight that this seems pretty remarkable, doesn't it? A couple of things that are useful is like the UK stock market is actually global. The UK is a small, open trading nation, and the company composition on the stock market reflects that. And you might say the same about the US, as I'm sure a lot of you know. Facebook's biggest market, I think, is India. They're locked out of China. They're not allowed in. But India is much more important than the US. And so the composition of stock markets, you think, why is stock markets doing well when parts of the economy are so weak? Actually, it's, broadly it's travel and leisure, isn't it? Which we acknowledge is really badly impacted by the pandemic. And you might see a different story with some of the shares there, or share prices. There's a very legendary hedge fund manager called Stan Druckenmiller. And I'll show you a book. I think Stan is in this. This is not scripted, by the way. It's not set up. Yeah, this is a really good book, Inside the House of Money, by Steve Drodney. And Jack Schwager does some really good interviews with fund managers as well. I'd recommend that. This is his new one. I'm I'm pretty sure Stan is in there or someone else is. Basically, these guys, they are super smart. They've made compounded 30% a year, made phenomenal returns. And I think one of the main points that Stan makes is don't fight the Fed. I don't know if you're familiar with this phrase, but so the Fed is the Federal Reserve in the US, and basically Stan's philosophy is follow where the money is. And I think it's quite a sensible way to look at it, isn't it? So find an industry that's got money flowing into it. So you might say, look, an obvious thing to do is think we're still probably quite early days in the internet economy. Not necessarily for some stocks that are pretty well penetrated like an Amazon, but there's a number of things that are really quite nascent in terms of turning the internet into an economy of itself. So you follow the big trends, and Stan's point about don't fight the Fed is if the Fed is got low interest rates and is opening up liquidity, it means asset prices will probably have more money sloshing around. That's been the story. I think most people would agree with the quantitative easing period, and now we're on to modern monetary theory in the US, where they have literally given money to people who've had to stay at home. So another stat for you, 25% of all US dollars in circulation were printed in 2020. The US has been an independent nation since the 1780s. And some people might say that explains why. That in March last year, governments around the world said, this pandemic is so bad, unless we print money and give it to people to spend and help them be on furlough and support businesses, we're going to have a cataclysmic economic outcome. And so when you look at it that way, you can kind of explain why a lot of shares have done really well. So in the technology sector, generally they're saying, look, adoption has accelerated. 2020 has been really good for technology businesses like Zoom. And so that might explain why those shares have done well. Broadly, there's more money in the world looking for somewhere to invest, and interest rates are zero, give or take. So you've got to put the money somewhere. Does that mean that there are risks? Yeah, probably. Elon Musk is the world's richest person, and his business has never made a profit. I doubt that has ever happened in the whole of human history. It's pretty extraordinary. So those are the two perspectives, and then Stan is on record publicly as saying he is short the US dollar because they're just pushing money out there. Some people might say that's why Bitcoin's done pretty well. In terms of the question that's just come in, why isn't there inflation yet? Well, there is, and markets are starting to price that. I think this is not controversial. I think this is a stated fact. There has been inflation for the past 10 years. It's been a couple of % a year. In some areas, much more. And then as we look through this, I think you can see that as saying you're trying to buy some things online at the moment and it's out of stock, or the price has gone up. And we've had this massive shock to the economy. Supply chains are really weak, but people have got money to spend and they want to. No one's been on holiday, no one's been out for dinner, no one's had to buy new clothes. And so some people, maybe almost the majority of people in the UK have got, exactly, out of toilet roll. Majority of people in the UK who are still employed are in a better financial position than they were a year ago, which is crazy, while acknowledging that some people have been horribly hurt by this, which is really unfair.
Yeah,
so that's
sure.
right. Long story short, there's more money in the world.
No, yeah, I understand. Okay, so firstly, I just want to say I've finished the interview with traders with Jack Traeger. I'm kind of proud of myself because for me, I don't really love books. I'm never into it, but this year one of my goals, 2021 goals, is to finish at least one book a month. Slightly a little bit over that, but I finished my first, and it was like 15 hours. It really took me really long, but But I finished that. Yeah, that's actually my second book that I wanted to get into. So yeah, thanks for reminding me. The other thing I wanted to say to you guys as well is, we're coming up, 15 minutes to the hour. So if you have any questions, just put it in the chat and then we can go over it towards like last 10 minutes or so. So Nick, now I wanted to talk to you a little bit about, structuring things and stuff like that, because as I said earlier, when it comes to retail traders, entrepreneurs like us, we are very small in the big ocean. But I believe you guys are just a little bit, hedge funds. You guys are a little bit above us. So I kind of wanted to ask you two questions. What is the structure like? Number one, and number two, we've had.
Emma just came in to get the monitor. Could you repeat that question?
Okay, cool, cool. So
right, and our dog is here as well, Harvey. He might make an appearance.
Yeah, no worries. The question one was, so you guys are a little bit above us in terms of, the whole structure of things, but how are you guys structured? Like, hedge funds and wealth management. What are you guys? How are you guys structured? And number two, we've had previous guests in the call where one of the key problems they were experiencing were because their positions were so big, they were finding it hard to get filled. Simply because with the massive volume, price was just jumping up, and then they would get filled at some other place, for example. So, maybe for you, what were some of your things that you've worked with? Or as I said, in terms of the whole structure things, do you guys have like your own in-house broker, or how does it work?
Yeah, that's interesting. Again, I don't think it's a controversial statement to say that liquidity feels a bit thinner than it has done historically. Jamie Dimon at JP Morgan has been on record as saying it's because banks can't take risk, they're not allowed to anymore. But one of the things that concerns me is the potential for deleveraging, which I think you saw back in March. So to your point, Gareth, about things have done really well. Lots of people seem to be on leverage trading markets. What happens if there's an event that turns that? We saw it in March. The US was down 35% in the blink of an eye, which is I think it was the fastest drawdown it's ever had. So that's maybe a bit of a lesson, and that's probably because liquidity is not great in markets, and we'd acknowledge that. Also acknowledge that there's a structural trend away from active fund managers to passives. So that's just indexing and use of ETFs as well. That impacts the liquidity. And the best stock I think I've ever picked is LSE Group, which is the first stock I put in the portfolio. Bought it £10, it's 97 today, I think. It's been a great return over about 8 years. And they are facilitating a lot of this move to technology to use ETFs and trading instruments like that. That's just structural. I don't think it's going away. So yes, that's very true. And another thing I would say about how we mitigate against that is we watch out for what we call lobster pots. And lobster pots are easy to get into and hard to get out of. Given the size of positions that we take, which might be 70, 80 million pounds, you've got to have a strong view that the company is a decent one to invest in, or the risk reward is good to take that position on. We don't trade in and out, so that's a way that we mitigate it. Again, I acknowledge, and sorry, that's not helpful for you guys, but that's one perspective. The other one is I'm very fundamental in the way I invest, but I think you've got to have a lot of respect for the market, and sometimes in general, I think the market figures things out quickly, more quickly than the individual. And if the market is, if I'm trying to buy something and I get filled straight away, it makes me a bit nervous. I think, what does someone know? So I pay respect to that. We have an in-house team of traders, it's 5 people. They're really good. They really help manage my stress, because when I was at the hedge fund, not only was I coming up with positions, I was doing my own trading. And I'm sure you'll know that's pretty stressful trying to get a decent price, make sure you've got your sizes right. When you're dealing with tens of millions and hundreds of millions of pounds, you don't want to get the decimal point in the wrong place.
Yeah. Okay. So yeah, that was that. I just wanted to on that note as well, I just wanted to ask you another question, which was fear of missing out. Okay, a lot of people have this fear of missing out. So you was you just touched on it last minute as well, which was you didn't get filled, or you started to feel some type of way now. But we can look at on that micro level, but we can also look at a micro level in terms of, okay, I've just learned this new strategy. I've just got some money in my account. Now I just want to get this going before this becomes the next trend, and then next thing I won't be able to trade this kind of way. So for you, as I said, you've been in the industry come close to 20 years now. You've seen the cycle go up and down. You've seen some assets come into the market, you've seen some assets get removed from the market and whatnot. One of the latest one in cryptocurrency was Ripple. Some brokers when allowing users to trade Ripple. But in the future we might have a new thing called digital yen. So I believe it's out already. They're getting that ready for 2022 in the Olympics. So how can someone tackle that fear of missing out? Being afraid of the market changing, being afraid of the market never being here, or something will happen to the market, or something like that.
Yeah, it's a really great question. And FOMO can be a very negative force at times. But I think it comes back to understanding why you own something and then stress testing that hypothesis. I think if you're jumping on board with something just because it's going up, it can work. That could be part of your strategy if you've got good stop losses and you're okay with buying momentum. But again, it comes back to this resulting thing that if it's going up and you're not sure why, and it's just because everyone else is buying it, got to manage your risk there. And I'd say broadly, often the way I feel instinctively is wrong. And another really great concept is Daniel Kahneman's thinking fast and slow. The fast part of your brain is the instinctive, possibly emerged early on in human evolution, which was if something's rustling in a bush, run away because it might be a lion. And it's that really fast reaction. The slow part is saying, looking at that going, it's not a lion, it's just windy, everyone else has run away. And this is my opportunity to make hay while they're all gone. So I think the FOMO probably fits into that perspective of just doing it because everyone else is making money. With the caveat that, as George Soros said, you make your money in bubbles. A bubble occurs when people just pay a higher and higher price for an asset. Something I probably should have mentioned already that I haven't done is the way I invest is I look at cash flow. And cash flow means I can value something and I have confidence in it. And if I think the cash flow is going up and it's not reflected in the share price, it's probably a good buy. That's pretty simple. With something like currencies or commodities, I find them hard to value because I can't say there's a yield. Like you can value a house because if you could rent it out, make a 10% return, it's cheap, so you buy it. If you rent it out and you make a 1% return, it's expensive, you don't buy it. And so that's how I work through with stocks and just try and have some dispassionate analysis of it as well.
Sure. Okay, so again, we've got about 5 minutes left. So that's kind of all of the questions from what obviously got here. But from the people in the chat, we've got so I'm going to start with the big one. So how do we start learning fundamentals at your level and understanding things like COT data and etc. That obviously hedge funds use, and what steps should we take to get to that level?
Well, that's interesting. There's loads of different ways to run money. I think my approach has been as people get shorter and shorter term, I will go longer and longer term. And that's how I invest. The thing about hedge funds is where they're doing high frequency trading things that you just cannot complete. That's just pure computing power. It's an arms race. I do think a good place to start is genuinely that inside the house money book, because that will give you different perspectives on how people trade. There's a macro trader, a long short equities trader, there's a group treasurer, and it just gives you different perspectives, and you might find that certain perspectives really resonate with you. And you go, do you know what? I think macro is my thing. I'd say for me, the caveat of what I do is I didn't know what the hell I was doing when I first started work. And I just felt like a complete fraud. And after 3 years, I think I just about started to get my head around it. But it was a long process of learning how to invest in companies properly and doing it at the scale that I do it now. So it was to do that, that's quite long and involved. I'd say a good place to start is just look at different trading strategies and see what works for you.
Sure. Okay. The second question was, so how does the, okay, so we've got retail traders here, so like dumb money versus smart money. So how does the massive influx of retail traders in 2020, 2021 affect the market overall, or any thoughts?
It's really interesting. Really interesting. Yeah, look, well, a couple of points on it. I think something you guys have all figured out is this, right? You used to be able to make money buying houses, doing them up. And that was broadly because interest rates just fell every year. So people were levered long bond markets, they just didn't realize it. Now interest rates are zero, I don't see how house prices go higher. So people got to figure out a different way to accumulate wealth. So when you look at it that way, I think it's pretty natural that people are going to have to find a different way to invest. And I think that's what's happened in Japan as well, where Japan went through this 20 years ago, 30 years ago. And people switched away from investing in the housing market to investing in options trading and stocks and currencies. So maybe it's structural. It's definitely started to impact the certain markets, so most notably the US. And I suspect that Reddit won't survive in its current form because some people would say it's market manipulation. That I'm not allowed to talk about any stocks that I own in the public arena by the regulator. And I respect that, it's there for a reason, but in the US it seems quite different. So I'm not sure how sustainable that current guise of squeezing shorts in GameStop is, but retail investors in the market, I think it's probably here to stay. The caveat I would say is they're using options in the US, and so that means they're using leverage and a lot of it. And that's generally a sign that things are quite toppy. So when we're looking at it, for, as I say, for Tesla to be up 700% last year, having not made a profit, and there being no shorts left in it now because they've all been squeezed out, and people long Tesla on options might make us a bit nervous. But as I say, I look at the risks, and I think it's a structural trend, but it's probably quite toppy.
Okay. And then this is going to be the last question, and it's just so many questions on the same topic, and it is, I know you've given a lot of books recommendation lately, but any more books on mindset and psychology that you would recommend?
Yeah, so many really. Just looking at the shelves now, particular ones that had a major impact on me. Yeah, there's a good one, a couple of good ones about it from an investing mindset. This is a good one, James Montier. It's basically about all the mistakes you can make, so the psychological biases that you carry in the stock. So basically all the things about how you avoid being your own worst enemy. which I think is interesting. So one example might be, it's fallacious to try and forecast. You make your money in markets not by saying what will happen, but by disagreeing with what's priced. It's a different concept. So yeah, I think that's pretty good. So that's the little book of behavioral investing. There's I think also like this, you'll find different things yourselves, just explore and then assess the credibility of the people. You know, the way I think, I found Charlie Munger really, really good. He's Warren Buffett's business partner. And there's a paper which you'll probably be able to find online. It's called The Psychology of Human Misjudgment. And that one I think is just brilliant. It's like 30 ways that people are stupid, basically. And Charlie's way of investing is saying, all I have to do is not be stupid like everyone else. And I found that really useful. So that's a good one that I would look up. The Psychology of Human Misjudgment. If you just Google it, I think there'll be a PDF somewhere. And then just keep exploring.
Sure. Okay, so that does bring us to an end, guys. Appreciate you all. So again, if you found some sort of value, if you've learned something new, let Mr. Nick know by putting a 111. Share the energy, give him that massive thank you. And again, Nick, thank you for your time as well. Appreciate you being here. We'll definitely catch up sometime at the pub once everything open. But Nick, thank you once again, guys. Thank you for hopping on, and I'll see you guys on the other call.
Thanks, everyone. Take it easy. Best of luck.
See ya.
Thanks, Gareth.